Welcome to the Deep Dive, the show where we really try to cut through the noise, stack up the sources, and pull out the key insights just for you. Today, we're diving into something pretty interesting. Actually, how companies account for their biggest physical assets. Things like buildings, machinery, the land they sit on. It might sound a bit dry, maybe.
Maybe a little.
But trust us, there are some genuinely surprising facts here about what actually counts as a cost. So, our mission today, it's really to unpack the rules for figuring out the initial cost of these big assets, and that's fundamental, really, to how they show up on a company's books. But before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, examples, explanations we talk about here, they're derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, a CPA candidate, or, already a professional, definitely visit the website. They've got additional practice questions, video lectures, and really detailed support to help reinforce today's topic. And a special thanks to Professor Farhat for providing this great material. Okay, so let's get into it. Let's unpack this, maybe starting with the basics. When we say plan assets or PP&E or sometimes fixed assets, what exactly are we talking about? People seem to use those terms interchangeably.
Yeah, they pretty much do. And they all point to the same core idea. The the tangible backbone of a business, you could say.
Yeah.
We're talking about assets you can physically see and touch. Think like a factory or a fleet of delivery trucks or maybe some specialized machinery. The really key characteristics are, first, they have to be tangible. You can touch them. Can't have PP&E you can't physically interact with.
Okay.
Second, they're used in operations. This means the company isn't holding them to sell like inventory. No, they're part of how the business actually runs.
Makes sense.
And third, and this is really important, they have a long, useful life, longer than just one accounting period.
Yeah.
This is crucial because it sets up how we handle them over many years, thinking about things like depreciation down the road.
Right. And for a lot of businesses, especially those in heavy industries, manufacturing, transport, even retail with all their stores, these assets are huge. They often represent the largest category of assets on their balance sheet. We're talking massive investments.
Absolutely massive. And when a company gets these big assets, there are really four main accounting challenges or issues that pop up. Today, we're zeroing in on the very first one, figuring out that initial cost.
Okay.
Once we nail that down, then later we can talk about, allocating that cost over its life, that's depreciation. Then there's how to handle spending after you buy it. And finally, what happens when you eventually get rid of it, the disposal.
Got it. So let's really zoom in on that initial cost then. If you're buying, say, a new piece of equipment, you naturally think, okay, what's the price tag, right?
Mm-hmm.
But is that sticker price really all that gets recorded on the company's books as the cost?
No, not at all. And this is where it starts to get interesting, actually. The general rule for acquisition cost is, well, it's much broader than just that purchase price. It includes all the necessary expenditures you have to make to get the asset ready for its intended use, ready for what you plan to do with it.
Okay.
And this idea, this principle, it's not just for PP&E. It's a pretty fundamental concept in accounting generally.
Okay, so it's kind of like, say you buy a used car online. You see the price, right? But then you've got shipping maybe.
Right.
Maybe you pay for an inspection before you finalize. You've got registration, taxes, tags. By the time it's actually in your driveway and legal to drive, the total you spent is more than just that initial online price.
That's a perfect analogy. All those extra bits are part of your true cost to get that car ready for your intended use, which is driving it.
Right.
So let's apply that. Let's make it concrete with some examples. Take a piece of machinery. The purchase price, yeah, that's usually the biggest chunk. But then think about taxes. You probably have sales tax, right? You can't really use the machine legally without paying that.
Sure.
If you ordered it from, say, California and you're in New York, you've got transportation costs.
Yeah.
Getting shipped across the country. That's included. What about insurance while it's on that truck? In-transit insurance. If you paid for that, that's part of the cost too. And then it arrives. You can't just, plug it in. Maybe it needs professional installation, special wiring, maybe even a concrete pad poured for it. All that installation effort, part of the cost. And finally, you'd probably want to run it, test it out, make sure it works as expected before you rely on it. Those testing costs, also included.
Wow. Okay. So if the machine itself costs, say, $100,000,
Mhm.
And then you add maybe $6,000 in taxes, $1,000 for shipping, $500 for the insurance while shipping, another $500 for installation and testing.
Right.
You're actually looking at $108,000. That's the number that goes on the balance sheet as the cost of the machine, not just the 100 grand.
Exactly. $108,000. That's the debit to the machinery account. It's a much fuller picture of the investment needed to get that asset operational.
That makes sense. It's everything required to get it doing its job.
Precisely. And the same logic applies to buildings, whether you buy an existing one or build it from scratch. The cost includes the purchase price or the construction expenses, sure, but also things like brokerage fees if you used a realtor, transaction taxes, lawyer fees for the closing, title fees to make sure the ownership is clear.
Right, making sure no one else has a claim on it.
Exactly. Any cost that's really essential to put that building legally in your name and get it ready for whatever purpose you bought it for.
Okay. Now, land seems like it might be simpler, but you mentioned surprising additions. What kind of things can unexpectedly inflate the recorded cost of land beyond just the purchase price and, like, realtor commissions?
Yeah, land can have some twists. Here's a really common one that catches people off guard. Let's say you buy a piece of land and it happens to have an old dilapidated building on it. But your plan, your intended use for that land, is to build something brand new, like a new office or warehouse.
Okay.
To do that, you first need to tear down that old structure, right? Get it out of the way.
Makes sense.
Well, the cost to demolish and remove that old building, that actually gets added to the cost of the land.
Wait, really? The cost of destroying something increases the value of the land on the books? That feels backward.
It does feel counterintuitive, doesn't it? But it flows directly from that ready for its intended use principle. If clearing that old building is necessary to prepare the land for your purpose, then that demolition cost is part of getting the land ready.
Huh. Okay.
Now, just to be clear, if you actually wanted that old building maybe to renovate and use it, then you'd account for the building costs separately. But if the plan is demolition from the start to get usable land, the demo cost goes to the land account.
Fascinating. Okay, what else for land?
Well, similarly, any costs to clear the land, maybe removing trees or rocks or grading it to make it level, those are also added to the land's cost. And here's another one. Overdue property taxes paid by the buyer.
Overdue taxes. How does that work?
Imagine you agree to buy land for $100,000,
Yeah.
but you discover there are $5,000 in unpaid property taxes owed to the county from the previous owner. Often, the county won't let the title transfer to you, the new owner, until those back taxes are paid. So to actually acquire the land free and clear, you might have to pay those $5,000.
Ah, so you're forced to pay it to get the land.
Exactly, because you had to pay it as a condition of acquiring the title. That $5,000 becomes part of your acquisition cost for the land. Your total land cost in that case would be $105,000.
Even though it's technically a tax payment.
Correct. Now, any property taxes you pay after you own the land going forward, those are just regular operating expenses each period. But that initial payment to clear the title is part of the land's cost.
That distinction is key.
Very key. And it actually leads us to another really critical distinction related to land. Is all spending on or around land treated the same way?
I suspect the answer is no.
You suspect correctly. The answer is definitely no. And getting this right is, well, it's vital for proper accounting down the line. We need to differentiate between land itself and things called land improvements.
Okay, land versus land improvements. What's the difference?
Land itself, from an accounting standpoint, is considered to have an indefinite useful life. We can't really put a time limit on how long a piece of land will be useful.
Right, it doesn't wear out like a machine.
Exactly. And because of that indefinite life, land is not depreciated. We don't allocate its cost over time as an expense. It just sits on the balance sheet at its historical cost.
Okay, not depreciable. That's important.
Very important. Now, contrast that with land improvements. These are things you add to the land. They're enhancements, but they are separate components. Think about things like putting up fences around the property, paving driveways or parking lots, installing outdoor lighting systems, maybe landscaping features.
Things that make the land more usable, but aren't the land itself.
Precisely. And unlike the land, these improvements do have a definite, limited, useful life. A fence will eventually rot or fall down, right?
Right.
Pavement cracks and needs replacing.
Yeah, 5, 10, 15 years maybe?
Exactly. They wear out or become obsolete over a predictable period. And because they have a definite life, land improvements are depreciable. We allocate their cost over their estimated useful lives, just like we would for a building or equipment.
Okay, so land. Indefinite life, not depreciated. Land improvements, definite life, are depreciated. That seems like a subtle distinction, but why does it matter so much for companies?
Oh, it has huge implications. Remember, depreciation is an expense. It reduces a company's reported profit on the income statement.
Right, which also generally means lower taxable income.
Exactly. So if a company mistakenly records the cost of, say, a new parking lot, which is a land improvement, and should be depreciated if they mistakenly lump that cost into the non-depreciable land account.
They lose out on those depreciation deductions.
Correct. They'd be overstating their profits and potentially paying more taxes than necessary year after year over the life of that parking lot.
And the other way around, if they tried to depreciate land?
That would be an accounting error, too. It would understate profits and misrepresent the company's assets. So correctly separating land from land improvements right from the start is fundamental for accurate financial reporting and tax compliance. It really affects the bottom line.
Got it. That makes perfect sense. Okay, so we've talked about buying individual assets, but often companies don't do that, right? They might buy a whole package deal, like maybe you buy an existing business, say a pizzeria, and the price includes the land it's on, the building itself, and all the ovens and kitchen gear inside. One price for everything.
Yep, that's a very common scenario. It's called the lump sum purchase, or sometimes a basket purchase. You pay one single price for a bundle of different assets.
So how do you handle that? You paid one price, but you now own land, a building, and equipment assets that need to be accounted for differently, especially regarding depreciation.
Right. The challenge is to allocate that single total purchase price among the individual assets you received. You need a rational, systematic way to do it. And the generally accepted method is to allocate the cost based on the relative fair market values of the individual assets.
Relative fair market values. Okay, how does that work in practice? Let's use that pizzeria example.
Okay, so let's say you buy the whole pizzeria, the land, the building, and all the equipment inside for one price.
Yeah.
$500,000 cash.
All right, $500,000 total.
Now, to figure out the relative fair values, you typically get an independent appraisal. Let's say the appraiser comes back and says, the fair market value of the land alone is $250,000. The fair market value of the building is $300,000. And the fair market value of the equipment is $50,000.
Okay, so if you add those up, $250K plus $300, say, plus $50K, that's $600,000.
Exactly. The total appraised fair value of the individual pieces is $600,000.
But we only paid $500,000 for the bundle. Maybe we got a good deal.
Maybe you did. So we can't just assign those appraised values because they add up to more than we actually paid. We need to allocate the actual cost, the $500,000, proportionally.
Proportionally based on those appraised values.
Correct. We figure out what percentage each asset's appraised value represents of the total appraised value. So for the land, its appraised value, $250K divided by the total appraised value, $600K, gives us, let's see, about 41.667%
Okay.
for the building. $300K divided by $600K is exactly 50%.
Right.
And for the equipment. $50K divided by $600K is about 8.333%.
Got it. Those percentages represent the relative value slices of the whole package.
Exactly. Now, we apply those percentages to the actual price we paid, the $500,000. So the amount allocated to land is $500,000 times 41.667%, which comes out to $208,333.
Okay.
The amount allocated to the building is $500,000 times 50%, so that's $250,000.
Half the cost goes to the building. Makes sense that it had half the relative value.
And the M for equipment is $500,000 times 8.333%, which is $41,667.
And if we add those up, $208,333 plus $250,000 plus $41,667. Yep, that equals $500,000, our total cost.
Precisely. The allocated costs must sum back to the actual purchase price paid. This method ensures each asset is recorded on the books at a cost that reflects its fair value relative to the others in the bundle.
And this is super important because, again, the $250,000 allocated to the building and the $41,667 for equipment will be depreciated over time.
While the $208,333 allocated to land will not be. Getting this allocation right at the beginning is critical for accurate future depreciation calculations, reported profits, and taxes.
Makes total sense. Okay, let's try to cement this with maybe a quick scenario, like something someone might actually face.
Sure, let's do that. Imagine a company buys a piece of property. Their plan is to build a future office building on it.
Okay, future building. Got it.
And they incur several costs in this acquisition. The purchase price for the property was $200,000. They paid a real estate commission of $6,000. There were legal fees related to the purchase of $2,500. They spent $4,000 on grading the land to make it suitable for building. And there was an old, unusable structure on the site, which cost them $3,500 to demolish and remove.
Okay, quite a few costs there. So the question is, how should the company allocate these costs? Specifically, how much goes to the land account and how much, if any, initially goes to the future building account? Think about that for a moment, listener.
What do you think?
Well, based on what we've discussed, that phrase future office building seems really important.
It is. It's the key.
And the principle is all costs necessary to get the asset ready for its intended use. Since the intended use here is preparing the site for a future building, it feels like all of those costs are really about getting the land ready. The purchase price, the commission, the legal fees, the grading, and even that demolition cost, right?
Yeah.
Because removing the old structure was necessary to prepare the land for the new building.
You nailed it.
Yeah.
That's exactly right. Because the acquisition was for the purpose of constructing a future building. Every single one of those expenditures, the purchase price, commission, legal fees, grading, and the demolition, is considered a cost of getting the land ready for its intended use.
So nothing goes to the building account yet?
Nothing initially. The cost to construct the actual new building will be capitalized to the building account later, as they are incurred during construction. But all these initial acquisition and site prep costs belong to the land.
Okay, so we just add them all up for the land account.
Correct. You'd take the $200,000 purchase price plus $6,000 commission plus $2,500 legal fees plus $4,000 grading plus $3,500 demolition.
Let's see, 200 plus 6 plus 2.5 plus 4 plus 3.5, that's $216,000.
Exactly. The company would record $216,000 as the cost of the land. Debit land, $215,000. Credit cash or notes payable, $216,000.
And again, this matters hugely because that entire $216,000 is now classified as land.
Which is not depreciable. If they had mistakenly allocated, say, the demolition or grading costs to the future building, they might incorrectly try to depreciate them later, or it would distort the initial cost basis of both assets. Accuracy right from the start is paramount.
Wow, okay. We have really covered a lot of ground today in this deep dive. We started off defining plant assets, those tangible, operational, long-lived things, key characteristics. Then we really dug into the initial cost, discovering it's way more than just the price tag. It's that all necessary expenditures rule to get it ready for use.
Right, the readiness principle.
We looked at some surprising things that get included, like demolition costs, boosting land value, or paying old property taxes to get title.
Yeah, the counterintuitive ones.
We clarified that crucial difference between land, indefinite life, no depreciation, and land improvements, definite life, depreciable, super important.
Absolutely vital.
And we learned how to handle those lump sum purchases using the relative fair market value method to allocate the cost fairly across different assets. That pizzeria example was great.
Yeah, illustrates the process well.
So if you step back and look at the big picture, why is getting this initial valuation right so fundamental?
Well, it really is the foundation for so much else in accounting and financial analysis. It's like the first domino. If you get this initial cost wrong, it throws off everything that follows. It affects your future depreciation calculations, which impacts your reported profits year after year. It affects your tax burden. It affects the asset values reported on your balance sheet. Ultimately, it affects how investors and lenders perceive the company's financial health and worth. So starting with the correct initial cost is just critical.
So thinking about this from the listener's perspective, what does this all mean for you? Well, understanding these rules doesn't just help you read a company's financial statements better. It can also help you think about evaluating, say, real estate investments, or even how you account for your own major purchases, metaphorically speaking. And maybe mull over that distinction we made between assets with a definite life versus an indefinite life. Think about other assets, maybe even intangible ones, in your life or in businesses you follow. Which category do they fall into? And what might that imply about their long-term cost or value in a broader sense? Something to chew on. Next time, we'll be picking up right where we left off, diving into how companies actually allocate these costs over an asset's useful life when we tackle the subject of depreciation. Should be another interesting